Boom! This is Fox Invests. Today, we're breaking down 5 investments that have historically beaten inflation. Not hype, not get-rich-quick nonsense. Real strategies that build wealth over time. And more importantly, I'll show you why most people still lose money even when they know this. Let's get into it.
Inflation doesn't explode your bank account. It erodes it, slowly, quietly, relentlessly. Every year, your money buys less. The coffee costs more. Rent costs more. Healthcare costs more. And if your money is sitting in cash, you are going backwards. Today, I'm going to show you 5 investments that historically beat inflation. But more importantly, I'll show you why most people still lose money even when they know this. Because the problem isn't access to information, it's behavior. Let's break it down.
Inflation in the U.S. averages around 2 to 3% long-term. That means if you hold $100,000 in cash, in 20 years, its purchasing power could be cut almost in half. That's not a conspiracy. That's math. So at minimum, your investments must grow faster than inflation. But here's where most people misunderstand investing. Investing is not about getting rich fast. It's about converting your human capital, your ability to work, into financial capital, and eventually reaching a point where your money works harder than you do. That's financial independence, and it doesn't happen by accident. Let's start with the core engine of wealth creation: stocks. Not meme stocks, not stock picking, not the next big thing. Broad, diversified, global index funds. Historically, global equities returned roughly 8% annually before inflation, about 5% after inflation. Over decades, that compounds massively. But here's the danger. Individual stocks are extremely risky. Many go to zero. A small percentage generate most of the returns. In countries, they rotate. In the late 1980s, Japan looked unstoppable. Its economy was booming. Its stock market dominated the world. Investors believed it would only keep rising. But if you invested at the peak in 1990, your inflation-adjusted returns were negative for decades. That's what happens when you chase performance. Chasing performance is emotional investing. Owning the entire market is strategic investing. You don't bet on winners. You own the system. Now, let's talk about bonds. Bonds are simply loans to governments or corporations. When you buy a bond, you're not buying growth, you're buying stability. They are less volatile than stocks, lower upside, lower downside. So why do they matter? Because investing isn't just about returns, it's about survivability. If your portfolio drops 40% and you panic, you interrupt compounding. And once compounding breaks, you start over. Bonds reduce volatility. They smooth the ride. They give you psychological stability when markets turn ugly. But let's be clear. Bonds alone rarely beat inflation in any meaningful way over long periods. They are stabilizers, not growth engines. The real magic isn't stocks or bonds. It's allocation. How much of each? 80-20, 60-40, 100-0. Your allocation determines your volatility and expected return. And here's the key. The best portfolio is the one you can stick with. If you can't sleep at night during a downturn, your allocation is too aggressive. There are now ETFs that automatically combine global stocks and bonds and rebalance for you. Simple systems win. Complicated systems impress. Choose wisely. Now, let's talk about something almost nobody pays attention to: fees. Fees are invisible inflation. You don't feel them, you don't notice them, but they also compound. If you pay 1% more in fees per year, it may seem insignificant, but over 30 years, that 1% can cost you hundreds of thousands of dollars. Not because of one mistake, but because of math. Fees compound against you. While your investments are trying to grow, fees quietly pull them back. And here's the uncomfortable truth. Most active managers do not beat the index. And after fees, most underperform. And even if someone performs well in one decade, it is almost impossible to predict in advance who will outperform in the next one. That's the trap.
The fifth investment isn't a financial product. It's discipline. Markets crash. Inflation spikes. Headlines scream. If you sell at the bottom, you lose. If you chase hype, you lose. The difference between the rich and the poor investor is not intelligence, it's consistency. Wealth is built boringly, quietly, predictably, and that's why most people don't do it.
But probability can be managed. Diversify globally. Control costs. Choose the right allocation. Stay disciplined. That's how you beat inflation. That's how you build freedom. This was Fox Invest. Stop waiting for luck. Start managing probability. If this helped you, make sure to like the video and subscribe to the channel. See you in the next episode.